And we're back for another week of technical analysis of the three major indices. Starting with the Dow, we had a pretty wild ride this past week, a lot of volatility, and we got within 1.7% of support. Now, this support line is spanning a very large period. It's going all the way back to last March, so it's over a year long. Now, this support does have a couple of small breaches in it, which is okay because we have three very solid touches, very evenly spaced out. We just hit this support back on March 5th and had a pretty solid run up and then this recent decline. With Friday ending on a real strong high note. Where does that leave us? We are quite a bit above support with quite a bit of volume. The volume isn't quite as great as it was in the last couple of weeks, but it's still much higher than average volume over the last several months. So what's going on now is meaningful. Is it a good time to invest in the Dow? I would be cautious. Right now, we're about 4 to 5% away from this support line here. So if it hits that support and breaches the support substantially, then we've got a long way to go before there's any other kind of support. In fact, I don't know what the next support would be. But let's take a look at the Nasdaq and see what it can show us. And right now, it appears that we're forming a symmetrical triangle. We have three very solid touches. And the symmetrical triangle means that the buyers and sellers are starting to converge. And what will happen is there will be a breakout either to the downside or the upside, which is generally indicative of the direction the market is going to go in the near to midterm. Oftentimes there's a breakout that is a fake out breakout, and it will break out, say, to the upside for a day or two, and then it'll sharply reverse, and that's the real breakout. So anytime there is a breakout, I always advise waiting 3, even 4 days for confirmation, because if it's going to break out in a meaningful way, then it's okay to wait a few days to see what that breakout really is. And then once it breaks out, give it a few days to confirm that breakout. Finally, let's take a look at the S&P 500. The S&P 500 has continued to show us two potential support levels, or if you want to call them two various patterns. The first pattern is this long-term support, which it has not visited in quite some time. The last touch on the support was the end of October, I think around October 30th. We have not touched it since then. However, we've had this new pattern forming that is basically, it's a megaphone, which means that the lows are getting lower and the highs are getting higher, meaning that the bulls and the bears are not in agreement at all on where the S&P 500 is headed. If we get some higher highs and then we get another correction of 10% or so, that means we're really in a megaphone pattern, and most likely it's going to breach this lower support of the megaphone pattern. If it does breach this support, the next support is this long-term support that's been going around for a long time here. If it breaches that support, then we're in big trouble. I would not be putting money into the S&P 500 right now. I would wait to see if this mid-range price is going to go up or if it's going to go down. And then I would want to wait to see if there's going to be a bounce or a breach. If it goes up and it just breaches through this megaphone upper resistance, then it's probably nullifying the megaphone pattern. If, on the other hand, it breaches this lower support line of the megaphone, then the megaphone pattern is probably complete. If it then breaches this support line, watch out. Right now, it's a wait and see on the S&P 500. That'll do it for the technical analysis on the three major indices. Stick with us. We'll see you next time.